One of the most important sections now of Unit 3, because it's your guaranteed question, it's a question that always comes up, and it's a great one to get lots of marks and demonstrate to the examiner that you know what you're talking about. So it's ratio analysis, in case you hadn't guessed. And I just like to produce a little, this is just something I've come up with, it's not a very neat and tidy acronym, but when we're looking at the ratios, and we need to look at 6 ratios, you need to know them off by heart, you need to be able to use them, but you also need to analyse the information, and I think it's really important to be able to illustrate what the trend is, so you know if it's improving or deteriorating. This is a nice little evaluative point as well. Sometimes the ratio changes, but by a very small amount, and making a judgment over the magnitude of that change is a good evaluation point. Knowing what causes the change is important to be able to analyse the consequences of that, and looking at whether the consequences are going to be long run or short run effects as well can be quite useful. Lots of other ratio analysis checklists, but we'll go through those later on. So firstly, this is taken from January 2014, and it's the Whitbread Premier In one. So we're just going to have a look at identifying, it's financial analysis, so you need to be able to find the profit and loss account and the balance sheet. So gross profit margin, first of all, so it's gross profit divided by revenue. So you find your gross profit on your profit and loss account. So here we have gross profit for 2012 and for 2011. Don't get your years mixed up, because then your trends will be the opposite. And then you're dividing it by revenue. And what gross profit margin is showing is for every £1 you receive in revenue, how much of that is gross profit. So we see it's gone from 85% to 83%. Rounds about, I suppose it's like more like 84%, isn't it, if you round it? So it's, if we go back to our checklist, it's deteriorated, but it's by quite a small amount. So I wouldn't say that that's too worrying, and you might want to question the data in terms of saying, well, we'd want to see what happened, in 2013, we want to see what happens in 2010. They do mention just before they give you this profit and loss that it had been challenging economic times, so it's not surprising that you've had a little bit of a dip there. But what I would say is we see that revenue has increased. So the reason it's dipped is, let me see if I can get another colour, it's your cost of sales have increased by more than your revenue. Your revenue's actually increased, so it's getting better. So it's your cost of sales. So maybe you could say, well, have they got control of those cost of sales, the control that they should have? So that's a little bit worrying, and you'd really want to know what the reasons were behind that cost of sales going up. In terms of making a judgment based on these, they're very high, I would say. So, getting 85p or 84p from every pound is a lot of money. But running Costa Coffee and running Premier In, I imagine most of the costs are tied up in the fixed costs, so that we'd see down usually with expenses down here, and that makes sense. You can see when we go to net profit, it is a lot smaller, but still very good profit margins, I would say. So net profit, if I go back to having my red pen, is net profit divided by revenue. So what it's saying is, out of every £1 that you get, how much is net profit? So there's our net profit there, and we divide it by our revenue, and we can see in terms of trend we've had an increase actually. So they've kept really good control over expenses, even though the gross profit margin has declined. So that's really actually fantastic news there. But it is, I mean, it is small in terms of magnitude, it is a small amount, and the cause has been because they've kept control of those expenses. So yes, they have increased. We can see they've increased from one year to the next. We'd expect that because we've sold more, but we'd expect them to keep, because these are going to be the fixed costs, so we'd expect them to keep a closer eye on those, and for them not to grow as fast as maybe cost of sales to grow. So overall, really, really positive. And if you compare that to what return you'd get if you put your money in to a bank account, which would be less than 1% in interest, that looks like a good company to invest in. You're gonna get much more back than a bank account. Okay, so on to return on capital employed. So for this one, it's a little bit more complicated. We're still using net profit here, but we need to work out capital employed. And capital employed, you can work them out two ways. Some other schools work them out slightly differently. Welsh Board accept both approaches, but this is the way I work them out. So I'm only explaining the way I do it with my students. So you can work them out either way, but basically what capital employed is showing is the money that's been invested into the business. So if we look at kind of shareholders' capital and then we add on our long-term liabilities, those represent all the money that's been invested into the business, both money that's, I suppose, the owners, but also money that's been borrowed and invested into the business. And you don't include, a student asked me the other day, why don't you include current liabilities? And I was like, well, current liabilities, that's not, like borrowing from a bank for capital expenditure, so investment projects. So that's why, so we wouldn't say it's invested into the business, any kind of current liabilities. So we can see here 2011 and 2012, and we've got an improvement on the return on capital employed, so that's good news. It's by less than 1%, so maybe not outstanding news, but as they've said in the case study, tough economic climate, that is good considering the conditions. And why has that happened? Well, net profits increased, as we can see there, and shareholder capital has actually increased, and long-term borrowings have increased, which would actually reduce this balance. So to say it's still increased means that your net profits increased at a faster rate. And what this means, consequences, is that it's very good news for investors. They're getting a better return back, but also maybe potential investors, it looks more attractive. And we can see, well, you can't see on this, but if you're looking at the case study, you can see the share price graph showing it going up. So that might be a reason why, because you're getting more of a return. Okay, on to liquidity now. So these are more profitability ratios, the return that you're getting from the business, whereas this is, can the business survive? Liquidity is generally what kind of pulls businesses under. It's not that they're not profitable, it's just that they couldn't pay their bills. So this is very important to see the survival of the business. So current ratio, current assets minus current liabilities, and we can see you get these from the balance sheet. So we've got current assets here divided by current liabilities there. And we can see that there is a deterioration, not by a huge amount. It's, what it's saying is for every pound that you owe, how much money do you have to pay it off with? So for every pound that the business owes, they have 44p to pay it off with in 2011 and 40p to pay it off in 2012. So 4p, not a huge amount, but it has deteriorated. Usually we say for current ratio, the standard rule was 1.5. Between 2 and 1.5 ... to 1. So for each £1 of debt you have, between £2 and £1.50 to be able to pay it back. That is a very traditional way of doing business. If you're doing B2B, you maybe want a larger current ratio because you might have more people paying on credit. But this is a business, Costa Coffee, you don't order a coffee and then say I'll pay you in 60 days, do you? You have to pay there and then. Same with Premier Inn. So we'd expect to see a lower current ratio and acid test ratio for a business that's B2C. We would expect this. And businesses these days are quite efficient as well, and they don't have to hold as much money in the form of current assets, so they can be investing it. And we can see they've got quite low stock as well. So we can see stock actually has increased there. So why has it decreased? Well, we're seeing current assets have actually increased, but it's your current liabilities that have gone up, and that's a bit weird, isn't it? Oh no, so creditors have gone down. Have they added that up incorrectly? Yeah, oh my gosh, just spotted a mistake. That should be 432, shouldn't it? Ooh dear. Whoopsie daisy. Oh no, it's not. It's, yeah. sorry, it's me. That's 280, isn't it? So creditors have gone up by 50, 40, 41. So, that could have some impacts. I'm going to tackle that later on when I come to that. Acid test, you're just minusing out the stock. The reason you're minusing out the stock is that's the least liquid of all of your acids. Acids. All of your current assets. And therefore, you just want to get, it's sometimes called a quick ratio as well, and you just want to get, say the business closed down now. How much of the current liabilities could you actually pay off? Because your stock, you're not going to be able to sell really, really quickly. So we can see still quite low. The traditional ratio was between 1.5 to 1.1. So anything above 1 would have been fine. And this is quite low as well, and it's deteriorated. It's really hard when you're looking at liquidity ratios. I would suggest you put in a line about, saying, well, to me this looks low, however, this might be the industry norm. What you'd want to do is compare it to Travelodge or Starbucks to get a gauge of whether this is a reasonable amount or not. Okay, gearing as well. Now, gearing is showing how much of the money that's been invested into the business comes from long-term liabilities, so how much comes from borrowing, basically, because the more that's borrowed, the riskier it is. One reason it's more risky, because interest rates can change, and that can change the amount that you pay, and it could increase your expenses. But also, for investors, they might be thinking, if you've got a really highly geared company, they might be thinking, well, your expense is going to be higher because you're paying back interest on loans that you have, and therefore, you're going to get less in terms of dividends. So this is another ratio that shareholders really would want to look at, or potential shareholders. Now, there are two ways of working this out. I always do it this way, and that means that if you get a number that's above 100, you've done it wrong. So go back and try again. But we can see here long-term liabilities, and we have to do it divided by capital employed, which is your shareholders' capital plus your long-term liabilities. And we can see there that this is the difficult one. Has it improved or deteriorated? Around about 50%, it's sort of in the middle. Below 50% is low geared, above 50% is high geared, and then at the extremes, kind of 15% and below, it's really, really low geared. And you'd say that the business is just not taking enough risk, really, and they could do with taking a little bit more risk, so they can expand the business. If you're up into like 85 or above, that's really high geared as a business. So this is not very interesting around here. It's neither like high or low, but it has increased. What we can say is this would seem maybe reasonable that it's increased. We can see it's caused through the long-term liabilities, nearly £100 million more of borrowing. But we can say that that's reasonable because they're growing. They're a growing business. They're trying to expand, so that's what they're spending the money on. And that's all the information actually I got from the case study, in case you're wondering. So if you've got a reason for this long-term borrowing, like the growth, which seems to be going really, really well, then you say, well, it's not really a problem, is it? It's not very high. Okay, so if we go back, which are long run, which are short run effects. If we're looking at like maybe a sudden jump in net profit or a sudden decrease in net profit, maybe that could affect your your net profit margin and your return on capital employed, you might say, well, what was the cause of this? Is it a general downturn in the market? Is it them not being a very good business? Was it something that was happening, for a while and then it's just hit them? Or is it just a kind of one-off freak accident that's happened? You've just had some really unusual trading conditions that have caused this. Because if it's bad but it's only short run, then it's less bad than if it were bad and in the long run as well. So that's something to consider. Also, with this question, you can consider, well, from whose point of view? So the question is usually assess and evaluate the financial position. or the position of the company. Well, from whose point of view? Because you could look at it from shareholders or potential shareholders. You could look at it from employees, and employees obviously would be a bit more interested in making sure the business is going to survive, and maybe more interested in liquidity and the gearing, because that can indicate maybe the long-term longevity of the business, longevity even. Suppliers going to be more interested in the liquidity ratios as well, because they want to know that they can be paid for what they're supplying the business with, because you can work out working capital, can't you, which is just current assets minus current liabilities. So it depends on whose point of view you're looking at as well. And again, the government could be somebody that you analyse it from the point of view. So here are a few non-financial factors. You can't always do everyone for every business, but if you work your way through them, the most important point is that you pick up some evidence. So market share, are they successful in terms of market share? Well, this is what I've just copied and pasted from the case study. I wouldn't recommend that you write this out in the exam, because, you know, you don't need to repeat what's there, but just pick out a few little factors. So is the UK's largest budget hotel chain, so seems pretty big. Again, largest, Costa Coffee, and they've got lots of, they're opening stores. They want to open 500 in China, don't they? So they're already kind of growing, and an international business. Largest. Okay, sales targets. Are they meeting the sales targets? Well, they don't actually say what they are, but it seems like, because they're saying in the annual report they're really happy, and they've got increased like-for-like sales, so up 11.1%. That seems pretty positive. That seems like they're happy with that one, and they've got cost has grown by 27.5%, which is pretty good. Maybe the restaurant's not doing quite as well, but it's still rough. Customer satisfaction, there's lots and lots of stuff in the case study. I only picked out one thing, but they seem to have really high levels of customer satisfaction. Productivity, I didn't really get anything from productivity, but I know this is financial and it's a little bit cheating, but if we go back to when we're talking about liquidity, we could say, we could look at debtors, because that's sometimes an indicator of productivity and how effectively you're working. So the debtors haven't really increased. So remember, debtors are customers that owe the business money. So they're keeping quite good control over their debtors here and making sure that they pay them. So that's quite good in terms of credibility. In terms of productivity. In terms of creditors, yes, it's grown by a lot, but maybe that's a good thing. Maybe they're just making their creditors their suppliers give them a little bit more time, it means, to pay, and it means that that money that they owe is not leaving their bank account, so maybe gives them a better cash flow position. So maybe. I didn't find as much on productivity as the other areas. Market share again, where are we going? Employee relations, 40,000 staff were among the most satisfied on the high street and in the hotel industry. That sounds really good. So less chance of industrial action. Loads and loads of things here. Obviously, you wouldn't be wanting to copy any of these out, but you might make reference to it, in line, whatever in the case study. It talks about, whatever. So lots of really positive things there. So overall, it seems like a really good business to invest in, but again, you might want to question at the end, your evaluative factors could be, is it enough to just compare 2 years' figures? Wouldn't you want to compare it with a few more years' figures? Also, try and pick up some competitors that you could compare it with. So I'm not too sure myself on those current ratios and acid test, whether that's reasonable. I'd want to look at Starbucks, I'd want to look at Travelodge and make a comparison there as well. And remember, there's company accounts aren't always accurate. They should be, but they're not always accurate. So making investment decisions or making decisions purely based on those things, because of window dressing, I suppose, there's always an element, I suppose, of uncertainty. And also you can link it into Unit 4 as well. It's a bit like forecasting, isn't it? You're looking at past data to say, well, will the business be doing well in the future? Well, that's a bit like driving a car by looking out of, the back window. So looking at what happened in the past to be able to determine what's happening in the future, it's very hard to do and a very dangerous way of driving. Not something I'd recommend.